is a good topic. It's timely. We've kind of touched on it before, but we haven't really dug deep into it, which has to do with recessions and market crashes and really how to help your clients stay calm. And this entire call this evening is going to revolve around the fact of a whole life insurance policy, answering objections that come up when someone says, oh, should I cancel it because interest rates and inflation are outpacing the policy right now, which is true because right now that is the case for the past few months. However, how do we help them stay calm? And a question that I would always ask yourself is, how do you stay calm? What gives you the assurance? Go back and revisit that instead of trying to figure out, well, what can I say to the person to try and win this argument? A lot of people go down that route and try and take the approach with the client to say, well, I'm going to prove to them I'm right. And it's almost argumentative. If you're the client and someone tries to argue with you, even if the tonality, the words they're saying, if it comes off as argumentative even one bit, and they're right, and you're the client, how effective is it going to be on you personally? You're going to shut down, right? A lot of us do. So I'm getting out of here. This is what I think. And this person's just trying to convince me on what they think is best, right? Not what's best for me, again, as the client. So when recessions and markets occur, market crashes occur, because they will. Everybody's afraid of one right now. So again, this will center around whole life insurance. And if you guys have questions, feel free to chat box, raise hand as I'm going through this, and we can definitely pause and answer questions as we go through it. So how to help your client stay calm. So the first thing I do, it comes up a lot, but yesterday it occurred with a client that I've been working with for a while. Between his policy and his wife's policy, he pays in about $200,000 per year, right? So decent sized policies where he's paid in. He still has the ability to. He's going on a premium offset, and his wife's, he's funding just the minimum for now. But in the early years, he did stuff them. They're decent sized policies. Let's just put it there. Smart guy, lives out in California. He's either in or nearby Silicon Valley. He's in the tech space and IT, so he's going to really dig into things. Very analytical individual, has a lot of questions and wants clear, concise answers. So he asked the question, which we're going to hit on more in this example down here. But he asked the question, hey, with whole life insurance, like it doesn't even outpace inflation right now. I know when I first got it, it seemed like a good idea because I was using it for real estate. However, I don't think it's a good idea right now because, firstly, my focus has changed. I'm not investing in real estate. I'm investing heavily in the stock market. And two, the returns on the policy aren't keeping up with inflation. That's his concern. So what I always hit on here is first I'll let the client know, hey, I 100% understand exactly where you're coming from. What I can share with you is a lot of people in a similar position to you, how they approach whole life insurance and how they use it, if you'd like. So I ask them that question. This way they feel more comfortable. If someone asked me the question, hey, is it okay if I share what other people do? Yeah, I would say yes. I don't want to force feed anything to them just because I've been in that situation where people just get motor mouth when they kind of get defensive and start spewing things out at me. And it's like, all right, like too much, let's slow down. So again, we want to make the person feel comfortable here. So going back to the core benefits of a whole life insurance policy: safe, liquid, tax-free. As far as the why people take these products out that we work with, those that are focused on the cash value, safe, the net internal rate of return, your net growth rate, is going to fall somewhere between 3 to 5%. Could do a little bit better, but to set expectations properly, 3 to 5% is likely what it will do. You've got the liquidity, you can access it anytime you'd like. And then, of course, the tax-free benefit has always attracted people. Now, people in 2008 continued to earn money. I remember, and I'll share this story with people sometimes. I remember when I was new in the industry, this was 2012, I believe. I was at a seminar. It was an annuity seminar where the wholesalers were discussing annuity products and the benefits. But one of the annuity wholesalers had a whole life insurance policy. He had it for a long time, and he just made a reactive comment when he was asked about whole life. And it was more or less like, man, I'm glad I had my whole life insurance policy in 2008. Like, I earned my dividend of 6%. Like, it just kept going up. I didn't have to worry about anything. It was a peace of mind product for him, someone who specializes in another product field, annuities in that case. Now, on to the objection point. I'm going to get into the story that I had from yesterday. Inflation and interest rates. Number one, and I already mentioned this, kind of, do not argue with the client. And something I've learned and come to appreciate over the years just of working with people, this is other agents, whether they work here at the company or they're outside agents that I've worked with over the years, is a lot of times someone comes off as argumentative and they don't even know it. I've done it. I've been told things that I wasn't even aware that I was doing. Like it all happens. Like, it happens to us all. But what we want to be very aware of, or have someone else make us aware of, is not to be argumentative with people that are giving you their money. Maybe they're not giving it to you directly, but they're putting it in a life insurance policy, which results in you receiving a commission. So you're being compensated for that. So you get paid as a result of them working with you. Do you want to be argumentative with them? No. Think of it again, if you're the client. If you give me money to put on a life insurance policy, let's say I'm your agent, you set this policy up, you like it during the good years, but then you've got an objection or a concern, and I come off as argumentative. Hey, don't you remember why we set it up? Like, we did it for this. Like, don't you remember? Right? Little things like that. What's your initial reaction? I know for me, sometimes we shy away. Like, we clam up. I don't know if I want to talk to this person because they're lecturing me. This happens a lot in the financial services business. So tonality, what we say here, just being aware of not being argumentative. And why this is so important here is because a lot of agents and professionals in our business, again, do this, and they're not aware of it. And it turns people off. You don't even have a shot to get referrals from them, future business. Like, we don't even realize it, and it kills the deal. Yes, maybe present the policy as a positive side of the argument. Yeah, exactly. Positive. Positivity is the big word I took from that. It's so important. So we don't want to argue. We don't want to be defensive. And this is in our words and tonality. If you're doing this, if you're communicating with someone via email, because I am very big on communicating with the prospect in the manner they want to communicate, whether that's over the phone, a Zoom call, text message, emails, whatever it might be. We all have strengths and weaknesses. Most people would prefer to do a phone call or a Zoom call because it's much easier to communicate something with illustrations and stories than it is through text, whether it's email or actual text message through a phone. However, if a client doesn't want to do that, we've got to figure out, well, how can I deliver this in an email? Sometimes you can leverage recordings, sometimes you can't. Right? It's going to depend on that client. But with email, it's most important here not to be defensive, because this is where we can jot something real quick and it can be beautiful, direct, to the point, and someone reads it and thinks you're yelling at them when you're not. We've all been there. That happens. So always good to read emails aloud. Maybe have an associate or someone you trust read it aloud as well if they're willing to do it, just to take that tonality in. These are the steps that people often overlook, 1 and 2, before you even get to the main point and the main objections. If we blow these 2, it's done. No one wants to work with someone that they view as a jerk, right? Just to put it that way. Not saying anyone here is jerks, but it's little things that can happen. Now, answer questions in a manner that you want them answered. So put yourself in the client's position. You ask a question, how would you want that answered? And this is complementing points 1 and 2. Don't necessarily want to be resold. You remember why you bought it. We don't want to remind someone why they bought the policy. We can hit on some points, highlighting the core benefits. That way they've got the opportunity to remember themselves, allow someone to keep their dignity. Very important to do that. But we never want to say, hey, here's why we did it. Don't you remember that? Out of frustration, we can do that sometimes naturally. Maybe we vent to ourselves, like we went over this a million times, but never ever do that in a meeting. Again, we've all seen that happen. And sometimes you can just feel the tension in the room when something like that is said. And then soon as tension occurs, what are your chances of saving that deal? Or if it's a new sale, winning that deal? Slim to none. Let's put it that way. All right. So on to the example of yesterday. So yesterday, the gentleman, he's a year or two older than me. So he's 35, 36 right now. Between him and his wife, $200K per year, how they set their policies up. So $20K base premium, I mean, it's a decent case. Whole life insurance, my whole life insurance policies, as I look at them right now, Steve, they're not keeping up with inflation. They're not keeping up with interest rates. Therefore, is it a good idea to keep them? Right? He didn't say this directly because he's a really nice guy, but that's where he was going as far as canceling the policy, because like just based on my strategy, what it was when I started the policy a few years ago versus what it is now, I don't know if it's a fit anymore. So that was him. Let me do this just to make this a bit easier here. Let's put what he says in red. And then what my comments and notes were in blue. I can send this to you guys as well. Okay. So my response there, when he's doubting his life insurance product, is I understand, when you look at inflation and interest rates, they are outpacing what your whole life insurance policy is earning right now, especially being in the fact that you're in the early years and you're earning 1%, it might hit 2% soon. It's still in the ramp up phase. It's going to max out your product, Mr. Client, right around 4% for you and your wife. So just telling him exactly what he has, not trying to make it look like something better than it is. You ever have someone do that to you? We don't like it. So what I can do, Mr. Client, is if you'd like, I can share how a lot of people we work with, or what a lot of people we work with do with their whole life insurance products, how they use the cash value, why they still use it when inflation and interest rates are higher, if you'd like. Yeah, I'd love that. Okay. So the product in itself is going to fall somewhere between 3 to 5%. Yours, Mr. Client, at around 4% annually. When we look at the annual IRR, it's a little bit higher than that. But kind of is what it is in that respect. Safe, liquid, tax-free. You can use it like you have been using it, just as a personal line of credit. A lot of real estate investors we work with will do that. He asked about dividend rates. He said, if interest rates go up, should my policy performance improve? So with dividends, they likely will come up if interest rates rise. Historically speaking, though, there has been a delay. What I mean when I say that is historically, when interest rates have increased, we typically see dividend rates increase a few years after. So if your dividend rate is 5.65% right now, and interest rates here in 2022, I'm just going to use an extreme example, go up to 8%, then you might see your dividend rate begin to trickle up. Let's call it beginning 2025. There's typically a lag, just a time lag there. So I do want to mention that piece as well. This way he doesn't think the dividend is going to start to increase next year. And then when it doesn't, he calls me again saying, hey, what's going on? And now he's got more of a reason to cancel it. So here, mention the part about the IRR, the dividend rate. let's continue on. So he's getting it. And then what I want to hit on here, a little bit of history. And when I hit on this history, I don't want to beat this up. It's not the purpose of this call. I never want to beat it up, actually, but you'll see what I mean. So what's interesting, Mr. Client, is that the concern you have, that frankly, the concern a lot of people have right now with interest rates rising and whole life not keeping up with the rising interest rate environment, is a concern that existed back in the 1980s. If you were to rewind the clock to the 80s, you would see some companies have a dividend as high as a little over 13%, which when we hear that today in the past decade, like that's fantastic. However, at that same point in time, when I could see a dividend rate be between 12 and 13%, depending on the carrier, I could get a CD or I'd have a mortgage rate of 16 to 18%. So whole life insurance dividends were not keeping up with other products out there, just interest rates in general. So interest rates were outpacing dividend rates, let alone the internal rate of return, because we know the dividend rate's not the IRR, and insurance companies were feeling the pressure. So insurance companies came up with different products. They released new products that will continue to drive revenue, called universal life and variable universal life insurance. And in short, what those products looked like at the time is you could purchase a universal life insurance policy, and the name of that product was Current Assumptions Universal Life. What that means, current assumptions, is that the illustration that I would show you, like the whole life insurance projection I showed you, Mr. Client, that illustration with that universal life insurance product were based on the current interest rates at that point in time. So what that means is you would see an illustration that would look beautiful. You had a 16% interest rate assumption. And the day I ran that illustration when interest rates were 16%, it assumed 16% forever. That would just consistently be paid to the policy. Looked great. Okay, it adjusted with inflation and interest rates. Hey, sign me up. Companies sold a ton of this product. However, rates came down. Universal life products had an increasing insurance expense. To just make a long story short, what was projected did not happen. The policies under-delivered. People were unhappy. A lot of people lost money. Didn't work out well. Back to whole life. Why I mentioned that, Mr. Client, is because of what's happening right now. A lot of people elected not to take out whole life insurance policies and looked for the hot product at the time that's paying a higher interest rate. So I'm in the here, now, in the moment, panicking, what move can I make? Human nature, right? So with whole life insurance, if someone purchased a policy back in the 80s, and we fast forward to today, the internal rate of return is somewhere between 5 to 6%, most likely, based on the policies we have that were issued back in the 80s. So that's 5 to 6% IRR, that's the net growth rate. In addition to that, that's tax-free. You get the safety, no risk. During market crashes, the dot-com bubble in 2000, 2001, the financial crisis in 2008, that also provided peace of mind. The person that had this product didn't have to worry about it. So at the time, when interest rates were high, it didn't seem like a good idea. However, over the long horizon, it was fantastic. Man, if I could go back in time and purchase that product, yeah, I would do it all day long. The thing is, when someone's somewhat caught up in the here and now, that's where we've seen people say, okay, if I could go back and do it over again, I would keep that policy, or I would take one out back then. And then to add some fuel to the fire in a good way, the person that kept that whole life insurance policy, when these occurred, these market crashes, They had that cash value that was guaranteed to keep on appreciating, which means what? Instead of using cash in their bank account, they're using cash value in their life insurance policy to expand into the marketplace. When I say expand, when you can purchase assets at a discount, now you can really do that using the cash value life insurance. So it can buy discounted real estate, invest in business, whatever it might be. Everybody's got their own thing as far as what they like to do. Point. You ever hear the phrase, it seemed like a good idea at the time? I've said that many times. Whole life did not seem like a good idea at the time. When we look at the immediate, I put gratification here, but call it the immediate impact. I look at interest rates today. Whole life insurance does not make sense today. However, it's just that slow turtle that is going to cross the finish line. I think I look back and think, okay, I want to make sure I've got somebody with that turtle, because no matter what happens, it's going to cross the finish line. Like there's no stopping it. It's going to do it. And I can leverage the turtle's money anytime I want. That makes sense. And with all that said, corporations do the same thing. That's where they position their safe asset and help weather financial storms. So one thing I'll add for you guys, and we can kind of open this to questions. What I try to interject in this story or this conversation here is questions. Does that make sense? Any questions on that part? Just because I don't want to talk the whole time. I just want to make sure that the conversation is really with both of us, and they've got a lot of questions. I'm answering their questions, because if I put them to sleep, then it's all for nothing. But as far as recessions and down markets, how to help your clients calm the storm, you've got the actual strategy, which we've talked about before, like taming a bear market. We can leverage whole life in a down market. That's cool with the numbers and such. This is definitely more on the emotional side of things, which is equally, and some may argue, more important than the actual numbers, because we're all emotional human beings, right? So if you've got a piece of property, let's say it's your primary home, and your mortgage balance is 200 grand, it could be anything, right? It's all relative to the individual situation. And you've got a policy with cash value of $250,000. So that's close to the danger zone. When I say danger zone, if you take a max loan, pay off the mortgage, and never pay anything back, because we're loaning out a lot. So here's what I would do. And here's what we do. So here's my policy. I would illustrate, let's show a policy loan in purple, policy loan. For $200,000, pay that off. I do want to know what that monthly payment was. Then I'll ask the client. So Mr. Client, Mr. and Mrs. Client, you can absolutely use your policy to pay off the mortgage right now. We do want to look at what the interest rate is on the mortgage versus the interest rate on the policy. We can also tally up if you stay the course with your mortgage. So if you leave it as is, what's the total dollar amount you're paying in interest? Not the rate, not just the rate, but the total dollar amount you're paying in loan interest. And then we'll do the same thing with the policy loan. So you have a $200,000 policy loan. And what I wanted to look at here is, one, if you repay it, and Mr. Client, I can show the repayments being the same monthly payment you've been applying towards the mortgage if you'd like. Do you like the idea of that? Or would you like to see a smaller amount, higher amount? Ask them. This way we can hear exactly the dollar amount they prefer. So let's repay it at that dollar amount. Then let's see what it looks like if you pay interest only forever, but you don't have to, but we can show you what that looks like. And then let's see what it looks like with no repayment. And this will show them as well firsthand the worst case scenario where we've taken a max loan and they'll see that cash value actually go down over time. A lot of people will avoid this. When I say people, your competitors, people in the business, like, I'm not going to show that because the client will freak out. No, they won't. Would you want to see it if you were them? Like, that's what I try and think. Yeah, so it's okay. Show them this because people often hear you don't have to pay policy loans back because you don't. But if we take out too much, we don't pay it back and it lapses, that's where issues pop up. If they know up front, they're going to come to appreciate it more. So show all three. And then they see firsthand, what do my options look like? Hey, if I do pay it back, what's the total amount? If I could write neat this evening, I pay in interest. I can show you how to do that just with an illustration in Excel. It's pretty easy to do. But this way they see, okay, here's my total interest cost, dollar amount. People from experience resonate more with a dollar amount than an actual rate. It's easier to follow just as I kind of experiment with both to see what a consumer responds to more favorably. Most the dollar amount, because the rates, you can see, hey, I've got a higher or lower rate over here and it ends up being like $5. Like, it's next to nothing when you look at the dollar amount. So again, do what the client wants, but I have noticed showing the dollar amount has been quite effective. So we started doing that more just because people respond favorably to it. So this is all pulled from an in-force illustration. This was a Mass Mutual Legacy 100 product where the individual, his original plan was to fund it at this dollar amount. And it's one of those cases where what he planned to do, he did exactly that. So it's what makes that fun is you can track the actual performance. Like, here's the actual break even with a real policy, not just a projection. So it's a side note, not addressing the loan, but just to add that there. And while this was the original plan, what he has decided to do, at least for this year, is pay just the minimum premium, and he might scale it up next year. He doesn't know. He likes how it's performing. He's got cash. He goes, okay, let me pay at least just the minimum. Maybe I'll add more next year. But it's common when someone has a plan to fund it for a short period of time to say, I like this. I want to add more, which is good. But point is, actual policy started in 2017. These values are from the actual in-force software, in-force illustrations. So what he asked for, he's got $657 in cash value. He wanted to see a $500,000 loan, and he wanted to see what that would look like with and without payments. So without fully repaying it, and then also paying just the interest. Let's look at no repayment first. Now, there's a technical detail here. I illustrated it year 8. He can take it now. Why I did it year 8? It's because Mass Mutual software stinks with their old products. Where if you exercise a reduced paid up with a loan on it, it wipes the loan out. So you can't, like, it would have made it ugly. I'm like, you know what? He can do it now. We can prevent that from happening. I'm just going to explain that and then show him how to take the loan now if he wants to. So for the sake of simplicity, I ran RPU because that's what he's considering at least now through our discussions, and then just did the loan afterwards. It made it easy. So this is loans, a $500K loan and no repayment. So at year 8, anytime you show a loan, this is my preference. It's been effective because it's helped people understand it. Show the growth illustration first and side by side with the actual loan illustration. I'll send the full illustrations as well in a zip folder. This way, from a compliance standpoint, they've got everything. But then I slap it on Excel because you know what an illustration with loans looks like. So we've got the IRR, net growth rate on an annual basis. We can plug in the average if you want. No. So loan interest 5%. And sometimes I'll throw a column in here that shows the loan interest rate because it highlights the fact that I'm paying 5% or 5% is being charged on the loan balance. And here's my net growth rate. So this immediately removes the belief, even though you've explained it to a client, but it removes the belief that my policy has a dividend rate of 6%, so I can borrow at 5% and have a positive spread. No. Here's your actual earning rate. So we see that now we are earning that almost 8% on the entire cash value balance. And we've got the 5% cost to borrow only on the loan. Just like a mortgage, we pay interest on the mortgage balance, earn appreciation on the entire real estate value. Now, to get back on track here, conceptually, my ugly handwriting, it was, okay, let's change this to $500,000, just to be consistent with the example we're looking at. And what does it look like if I transfer it over to the policy? So I'm going to borrow from my policy, pay off the mortgage now. Did that, we see what it looks like if he doesn't pay it off. Let's look at interest-only payments here. So here, we've got the growth example, and we've got the internal rate of return. We also have the dollar amount, the net cash value appreciation that he sees every year. That's the net growth, excluding his payments. So in purple, you've got the 5% to 500,000. That's the actual interest he's paying each year in this example. So what some people like to see, something like this. What your competition, who is anti-whole life insurance, will point out is this. Anything that you've seen competitors point out to attack whole life, or anything that if you are on the other side to say, hey, what are the deficiencies or weaknesses here? I do like to highlight those kind of as a pros and cons presentation standpoint. I'm not going to come and say, oh, life stinks and here's why. Obviously, we're selling it. We know the benefits, but it's good not just to talk about the benefits. A lot of people, especially your higher income earners, appreciate that because they feel like, all right, this person's not just trying to sell me something, like they're advising me on what to do and what not to do. So with a mortgage, this is where it really helps someone where they see, what do I pay in total interest or financing costs, if we want to use that verbiage, to the insurance company versus the bank? Because we know the interest rate on paper could be lower or likely is lower than the policy. However, we also know with how interest works, it's very front loaded. I'm paying mainly interest in the early years on a mortgage. So like take the rates and any games, when I say games in the client's mind, what might be a money game or a rate game, what's the actual dollar amount look like? Simplify things. And that'll really help them so we can see this side by side with the mortgage. If we wanted to make it a fair comparison, we can show, hey, if you continue on your same path to the mortgage and you've got 25 years to go, well, let's pay this loan off now over 25 years and then do the same thing where we can tally up the interest payments and have some fun. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.